In this video, we're going to talk about the long put options trading strategy. Now, something that you need to know is that the value of a put option will increase if the value of the stock decreases. Now, the put option has two parts to it, the intrinsic value and the extrinsic value. In this particular example, the stock is currently trading at $87. And Jim, he buys a 60-day put option with a strike price of $90 for a cost of $7. So the value of this particular put option is $7 right now. To calculate the intrinsic value of a put option is the difference between the strike price and the share price, or the price of the stock. Now, for this particular example, the strike price of the put option is $90. The share price is currently $87. So the intrinsic value is $3. The put option is a contract that gives the owner the right to sell the stock at the strike price. So during any of the 60-day period while this put option is in force or is active, Jim can sell 100 shares of stock at $90. So right now he can go to the market, buy the stock at 87 and then sell it at 90 for a profit of $3. So that represents the intrinsic value of the put option. So if the intrinsic value of the put option is $3, that means the extrinsic value is currently $4. The intrinsic value of the put option depends on the share price. Notice the negative sign. This indicates the inverse relationship between the stock price and the put option. That's why if the value of the stock goes up, if the value of the stock goes down, the value of the put option goes up. And vice versa. If the stock price goes up, the value of the put option goes down due to the negative sign. Now, as the stock price goes down, you need to understand that the intrinsic value of the put option goes up. That's why the whole value of the put option goes up. Now, there are some other things that affect the pricing of the put option. The next thing is implied volatility. When implied volatility goes up, the value of both call and put options go up. But more specifically, the extrinsic value of the put option goes up. The second thing is time decay. Now, when he buys this put option, it has a 60-day expiration period. As that time decreases, that is the time to expiration, as that goes down, the extrinsic, I always say that word wrong, the extrinsic value of the put option will decrease. So the entire value of the put option will go down. Now, if the put option is completely in the money, then there may not be any extrinsic value depending on where the put option is. If there isn't any extrinsic value, if the entire value of the put option is intrinsic, then the implied volatility and time decay doesn't affect the value of the put option anymore. It only affects the extrinsic part of the put option. So now that we understand that, let's move on to this problem. So let's go ahead and calculate Jim's ROI if at expiration the stock moves to these 4 different prices. Afterward, we'll create a profit loss diagram to show you the profitability of the long put option strategy and any risks that is involved with the strategy as well. So right now, Jim paid $7 for the put option. One put option contract controls 100 shares, so he is spending $700. Thus, his trading account will decrease by that amount. Now, the stock is going to move to $95. So using this formula, we have the strike price, which is 90, minus the share price of 95. Now, the intrinsic value can't be a negative number. So if you get a negative result, that means that the put option will expire worthless. So he can't sell it for anything. Therefore, he's looking at a $700 loss. So his ROI, because he lost his entire investment, is negative 100%. Now let's move on to part B. For part B, the strike price remains $90 and the share price is now $87. So the intrinsic value at expiration is going to be $3. Notice that the price of the stock didn't move, it stayed the same. So the extrinsic portion of the put option went to 0, which it always does at expiration. But the intrinsic value is $3. So he spent $700 on the put option, but at expiration it's worth $300. So he can sell it for $300. So thus he's looking at a $400 loss. To calculate the ROI, we're going to take the profit or the loss being 400, and we're going to divide it by the cost of investment, which was 700, and then multiply it by 100%. So his ROI for this particular trade is negative 57.1%. So because the price of the stock didn't move in his favor, he still lost money. Now let's look at the third scenario. Let's say if it did move in his favor, if it goes to 80. So the strike price is 90, the share price is 80, so the value of the put option is going to be worth $10 at expiration. So he put in 700 to buy the contract. Now it's worth $10 times 100, so he can sell it for $1,000. Now he's looking at a gain of 300. So to calculate the ROI, it's going to be 300 divided by 700 times 100%. So he's looking at a gain of positive 42.9%. So that's not bad, but that's because the stock moved rather significantly in his favor. Now, let's look at part D. Let's say if it moved big time in his favor. The strike price is 90. The share price at expiration is 59. So 90 minus 59 is 31. So that's going to be the value of the put option at expiration. So he paid 700 for the contract, and now it's worth $31 times 100, so he's going to receive $3,100 at expiration. Negative 700 plus 3,100, he's looking at a gain of $2,400 for this particular trade. So as you can see, if the price of the stock moves down significantly, the potential gain for this particular strategy can be quite significant. 2,400 divided by 700 times 100%, he's looking at a gain of, or an ROI of 342.9%, which is very good. But that's if the stock moves significantly in his favor. Now let's talk about how we can draw the profit loss diagram for the long put option strategy with reference to this problem. So first we need to draw the y-axis and the x-axis of the graph. The y-axis represents the profit and the loss of the trade. So if the trade is anywhere above the x-axis, it's going to be profitable. Anywhere below the x-axis, you're looking at a loss. The x-axis represents the stock price at expiration. So to draw the profit loss diagram, the first thing you want to do is plot the strike price. So the strike price is $90. The second thing you want to do is calculate the break-even point. For the put option, it's going to be the strike price minus the cost of the put option. So it's $83. So in order for this strategy to be profitable, the stock has to move below $83. And that's why part C and D these were profitable values because the stock moved below 83. Now the next thing you want to do is calculate the maximum loss. The maximum loss for this strategy is the cost of the put option, which is $7 times 100 shares. So the most that Jim could lose is $700. So first, we're going to plot a point at the maximum loss and the strike price, which is 90. Next, we're going to plot the break-even point. So at 83, the profit will be 0. So it's going to be on the x-axis. Next, let's draw a line to connect these 2 points. And let's make this line straight as possible. Now, if the stock moves above 90, the loss is not going to change. It's going to remain 700 because that's the most that he can lose. Well, now you know how to draw the profit loss diagram for the long put options strategy. So to review, remember, for this strategy, the risk is limited. The most that Jim can lose is $700. He cannot lose more than what he paid for in buying the put options contract. Now, his potential profit can go very, very high. Now, we can't really say that it's unlimited because the value of the stock, there's a limit to how far it can fall down to, and that is 0. I haven't seen a stock fall down to a negative price. I mean, if it could, then this particular strategy would be unlimited. But because we haven't seen negative stock prices before, this strategy is limited until the stock goes to 0. So that's it for the long put option strategy. Hopefully you now understand how it works, its potential profit, and also the risk associated with it. So remember, if the stock price moves up, the value of the put option is going to expire worthless, which isn't good. If the price of the stock stays the same, well, this option strategy won't be profitable. Depending on where you buy the put option, meaning what strike price you select, it may not go to 0, so to speak, if you buy it in the money. But nevertheless, you'll still be losing money if the price of the stock doesn't change. You'll lose the extrinsic portion of the put option. Even if it goes down a little, you could still lose on this trade. In order for it to be successful, the price of the stock has to go down a lot. Then it becomes profitable. So make sure you understand that. So the long put option strategy is profitable if the stock falls significantly. Likewise, the long call option strategy is profitable if the stock rises significantly in price. So that's it for this video. Hopefully you found it to be educational, and thanks for watching.